So if you're still struggling day trading, trust me, I know how it feels and I've been there before. And honestly, I'm still trying to figure it out. But one thing that significantly improved the way that I trade is learning how to draw key levels. So in today's video, I'm going to explain to you guys what key levels are, how to draw them, and lastly, I'm going to show you guys some live trades of this being implemented. So I value your time. With that being said, let's go right into it. So all a key level is just a certain area or a price point where price has a higher likelihood of having some type of reaction at. So in other words, you could say that's an area where a lot of liquidity is located at. So what happens is that when price gets to this certain area, you can see a lot of support or a lot of resistance. And price has a higher likelihood of having some type of reaction, which could lead to a trading opportunity. So let's take a look at the charts and talk about how to draw key levels and what type of price action you can expect when price gets to these key levels. All right, so for today's example, I'm going to use Apple, ticker symbol AAPL. So currently right now, I am on the 1 minute time frame. So I use Robinhood Legend as my trading platform. It doesn't really matter what trading platform you use. The concept is going to be the same. So let's talk about what key levels do I typically look for. So typically I look for the pre-market high, the pre-market low, the previous day high, and the previous day low. All right, so now let's talk about how do you draw these key levels. So you're going to go to your line tool on whatever brokerage that you use. And basically what you're going to do is to draw your previous day high and previous day low, you're going to go to your intraday day hours. So I'm in the central time zone. So that's like from 8:30 till about 3 p.m. Right. And what you're going to do is find the highest point of the day in order to draw your previous day high. Right. This includes the wick as well. So in this case for Apple, on this day, the highest point of the day was roughly about right here. So I like to color code my previous day high, previous day low, pre-market high, and pre-market low, so that I can just easily know, which levels price is reacting at. So that's how you mark your previous day high. So now let's talk about how do you mark your previous day low. The same concept, but you're going to find the lowest point of the day. So in this case for Apple, the lowest point of the day is going to be right here. And what I'm going to do is change the color to red. All right, now let's talk about how do you mark your pre-market high and how do you mark your pre-market low. So what I like to do is basically any point after the intraday period, I consider pre-market, right? So what I'll do is I will look for the highest point of the day, highest point of the pre-market, which in this instance is right here. It's around 3 a.m., right? And then I'll look for the lowest point of the pre-market. It's going to be your pre-market low, which is going to be right here. And once again, I'll change the color so it'll be easier for me to be able to identify when I'm trading during trading hours. So just like that. So that's essentially how you mark out your key levels. So remember, previous day high is right here. At this highest wick, previous day low is right here. This is the lowest point of the intraday. Pre-market high is going to be right here. This is the highest point, and the pre-market low is going to be right here. So let's talk about what type of price action can you typically expect to see at these certain levels. So I'm going to draw out 3 different examples and try to break that down for y'all. All right, so these are like the 3 different things that, from my experience, what I've typically seen and what you're probably typically going to experience when price gets to these key levels, right? So what you might see is, let's say you're in an uptrend, right? Price may come here, close above the key level, do some type of retest, and then some type of breakout that creates a trading opportunity, right? Another thing that price can do, sometimes price can just hit the key level and just consolidate on these key levels and not do too much at all. Another thing that price can do, let's say you're in a downtrend, price may hit here, have some type of retest, come back and break through the key level and create some other trading opportunity. Right, so those are kind of like the different things that you can see or expect whenever price hits these key levels that we've identified. So let's look at Apple again, and let's look at the past 2 trading days and talk about how you can utilize and analyze these key levels. So the most recent trading that we had, which is this past Friday that just went by, you can see that Apple had a strong move above your key level. It had a strong move above your pre-market high and your previous day high. And look at what happened. Apple had this retest and then this breakout above your previous day high, which created a great trading opportunity. Apple basically just went up the whole entire day, right? Another thing you can do when you're analyzing key levels is it allows you to be objective in the stock market. For example, if price is trading above your previous day high and especially your pre-market high, trading above both of them, you can objectively be bullish on the stock, right? This is telling me that price wants to push higher than where it was during pre-market and the previous day, which is typically a strong sign that price action may continue higher for the rest of the day, right? So if we go back a little bit more now, let's analyze Apple on the previous day, right? If I draw my levels on the day before, right? So previous day high up here, previous day low right here, pre-market high in this case is going to be up here, and then my pre-market low is going to be down here, right? So now if I'm coming to the previous day and trying to analyze what price action may do, we can see that, so whenever Apple opened up, it had a strong reaction on your previous day low and your pre-market low. You can see price kind of wicked up, opened up down here, wicked up, and then closed down. So I had a retest and a breakthrough, which also created another trading opportunity. But what you can also see is that since price was below your previous day low and your pre-market low, you could have objectively been bearish on the day and looked for some type of trade on the downside, right? And that's exactly what happened in this day for Apple. So I'm not saying this is always going to be the case, but your key levels will allow you to be objective in the stock market and just try to trade the trend overall. All right, so I hope that made sense to y'all. And at the end of the day, the stock market is going to do whatever it wants to do, right? Just because your stock is trading above the previous day high and the pre-market high does not mean that it has to be a bullish day. But all this is doing is that it's allowing you to be more objective with your trading and allowing you to be more in tune with whatever the trend is going to be for that day. It doesn't have to work out. It's not going to work out perfectly every single time, but as a trader, it just allows you to be more objective and just go with the flow that the market is providing. So now let's look at some live trades and talk about how it's able to execute. All right, so let's break down this trade and basically see what happened. As you guys can see, I have my key levels marked out. If we go back to the previous day, you guys can see this is the previous day high. This is the highest point of that previous day. This is the previous day low. This is the lowest point of that previous day. This is the pre-market high. As you can see, this is the highest point of the pre-market, right? So the area after your end trade day, and this is your pre-market low. This is the lowest point of the pre-market around this area right here. So you guys can see, whenever price opened up, whenever the market opened up, we had the strong move up to your previous day low. So you guys can see price didn't exactly touch the previous day low. A lot of times you can have some type of zone, right? Rather than drawing just a line, you can have a zone because it's not always going to be perfect, but it's going to be in that general area where you're looking for some type of reaction. So price hit that previous day low area, had this retest, and then had this breakthrough, which created a trading opportunity. So how I like to trade, I like to use the EMAs. So I have the 9 EMA, the 21 EMA, and the 50 EMA. And what I like to do is I like to basically trade the trend that the market is presenting. And I look for stocks with strong trends, either upwards or downwards. So in this case, IWM had a very strong trend upwards. And how I knew this is because I had good separation on the EMAs and price was trading above the 9 EMA. That's simply a sign that the stock wants to go higher. And what I like to do is I like to look for some type of retest on the 9 EMA or the 21 EMA, and then for some type of continuation to show after that retest. So in this case, IWM came down, touched this 9 EMA, and had this strong continuation upwards. So that was telling me that the stock may want to push higher. So objectively, I was going to make my bet on that. So this is why I got call options roughly right here. My stop loss would have been at the bottom of the body of this candle right here, roughly around where I entered. So just in case, like if this was a double top and price and I had a big candle that closed below my stop loss right here, right, I would have got out at minimal loss. So it's always good to have a well-defined stop loss. So in a situation where a trade does play out, kind of like this one, what I also like to do is use the EMAs to let me know when I should start cutting my position in the trade. So what does this mean? For example, if I had 3 contracts of IWM whenever I entered into this play, I may hold on to my contracts until I get it close below the 9 EMA right here, and I can close one contract. Then if I get close below the 21 EMA, I'll close another contract. And then finally, right, if I get it closed below the 50 EMA, which happened all the way down here, you can close another contract and get out of the position completely. So this allows you to basically catch the whole entire move whenever a stock has a really strong trend, either upwards or downwards. So in this case, I did close all of my positions roughly right here, only because I was honestly just happy with the returns that I got. And there's nothing wrong with that. So when you're trading, and honestly, if you're happy with the profits that you got, there's nothing ever wrong with taking profits and moving on to the next trade, which is basically what I did here. All right, so I hope that makes sense to y'all. The point of the matter is that no matter how you trade, whether you use inverse fair value gaps, fair value gaps, order blocks, what else, Fibonacci's, no matter how you trade, what indicator you use, it's always important as a day trader to have your key levels marked out. Because as you can see, these are areas where price has a high likelihood of having some type of reaction that which could create a great opportunity for you or a great trade opportunity. So like I said, it doesn't necessarily mean that price has to have a reaction at these points. It's just what typically happens. It's also what other traders and institutions that trade are also looking for. So I hope you enjoyed the video. If it made sense to you, you learned something new, make sure you like, comment, subscribe, and I'll see you guys in the next one.